So between growth scares and earnings scares, will we see a dove or a hawk take flight tomorrow? We ask our floor show traders, Phil Flynn and Thomas Hayes. Tom, let me begin with you. Are you in the dove or the hawk camp for Mr. Powell? And, you know, the market's up. The market thinks he might be a dove because it's pricing in that the Fed cuts rates next year. What do you say?
Yeah, well, my bet, Lauren, is a continuation of jawboning. Talk hawkish, act dovish. Bring down inflation expectations, but don't tighten more than you have to. As we saw with the quantitative tightening schedule, they've only completed 1/3 of what they had expected to complete by this time. It's kind of like the Hotel California. You can check in, but you can never leave. And we saw that from the ECB. They've already had to start a facility to buy periphery bonds as hedge funds are now shorting Italian bonds at the highest pace since 2008. So they want to move, but they don't want to move too much. And we heard from two Fed presidents, Esther George saying lags from policy are long and variable. And Fed President Harker said that we've had 86 hikes since 1983. 75 of those were below 50 basis points. He said 75 basis points is unusual, but 50 basis points is still substantial. So he's setting the table. 75 is probably not going to be the case. Ooh. We got to watch the CPI numbers. We have to watch the PPI numbers, and we have to watch the jobs report more than we have to watch Jackson Hole moving forward in September. More than Jackson Hole. Okay, Phil, let me bring you in here because, you know, this is mission impossible for Jay Powell and the Fed, right? 50, 75, yes. It doesn't matter. It's they're going to have critics either way.
He does, you know, and I think Tom hit it on the head. I think he's a dove hawk or a hawk dove. I mean, can you mix the two? It's like a new character, a new superhero or something. But yeah, I think it is. But I think the market's done that.
Phil, this is the man who said inflation was transient a year ago this month. Come on, a superhero.
I know. He just changes his uniform. Remember, then they changed the definition of transient. You know, it's like if it doesn't work out, you just change the wordage. No, but listen, I think the market's done the heavy lifting for him. The damage has been done, right? The market has been fearful, maybe too fearful, of the Fed being way aggressive. You know, we were hearing points and a half a few months ago. And I think if you look at the yield curve, I mean, the work's done. So I don't see any advantage for Mr. Powell to come off, you know, too hawkish and real tough at inflation at this point. Besides, we have had a drop in energy prices. We still have an inflation problem. The Fed can't solve it, right? They can't build factories. They can't start drilling for oil. I wish they could. Maybe they'd start doing it. But, you know, so there's only so much they can do. So I think he's going to be hawkish. But I do think this. I think the market has been too negative. And I think we could see a short squeeze. You look at all those earnings. I think we're seeing companies that were making so much money during the pandemic. They're facing challenges. A lot of them are still going to make a heck of a lot of money, but we're going to see a rotation, I think, back away from these high-flying tech stocks into, you know, more traditional stocks. And I think we're seeing that. And I think if you look at earnings and income at these companies, they're still making a lot based on their stock price, where you look at oil companies, for example, they're undervalued in comparison. So I just think you're going to see a rotation, but the overall market, I think, is going to do great.
But speaking of oil companies, Phil, they are making a lot of money, right? Because the price has gone up pretty reasonably. Tom, does this all come down to the jobs report? Because, you know, Phil made a lot of good points there. The consumer and companies, everybody's holding up. Technically, we're in a recession, but it's like, what recession? Everybody's still doing okay. So is the Fed going to force unemployment up and the job market to really turn before they're done?
Well, I think we're going to see that on a lag basis. But I also think Phil was spot on because if you look, you know, the market's going to continue to do well because managers were caught flat-footed. We've been very constructive on this show about the market since the June lows. Most managers missed it. They don't believe it. They're caught off sides. And if you look at the Bank of America most recent survey from last week, they have cash levels at the same levels as the great financial crisis lows in March of 2009 and the pandemic lows of April of 2020. So the pain trade is still higher, even if we have to consolidate the gains from June for a little bit before we take the next leg higher. So my bet is talk hawkish, act dovish, and I think we go higher after a little consolidation.
Talk hawkish, act dovish. It's a hawk dove after all, Phil. So I'm looking at some.
I want a T-shirt with that on it. So
someone has to design the cape, the superhero cape for you at this point with that
That's
logo.
Right. Thank you.
Can you explain to me then, Phil, why if you look at the performance of the different sectors of the economy today, I mean, investors are obviously feeling good. They're selling defense, right? Utilities are completely flat, and just moments ago, staples were the only sector that was down, and it was just like slightly.
Right. You know, I think what we're seeing here is people fear of missing out, getting back into the stock market here a little bit. I think you're seeing that. I think you're seeing this rotation. But, you know, I think you get back to the overall situation where we're at right now. Where are we going to be 6 months from now, a year from now? The one positive thing about a transparent Fed, you know, we pretty much know that rates are going up. And I think a lot of businesses have already adjusted to that. And I think that's why the stocks are performing pretty darn well.
So how much are they going up, Tom? Because the Fed's Bullard, who's been the biggest hawk of them all, if you ask me, he sees the rate being 3.75 to 4 by the end of the year. How are you going, Tom?
I'll take the under on that.
Okay.
I think they parade out Bullard when they want to bring inflation expectations down, and they parade out Powell when they want the market to stabilize. And that's kind of been the game plan.
Oh.
My guess is Powell comes out a little bit dovish tomorrow, and then they have 6 speakers on Monday and Tuesday saying, no, we're really serious about inflation, and the market won't buy it, and they'll push higher. And that's really going to name of the game. I mean, the big joke is that the most hated sector in the world right now is the best performer today in Chinese stocks, which have been a train wreck, and now everyone's buying them on the hopes of this Wall Street Journal exclusive that a audit deal with the PCAOB is going to be happening, where our regulators can go to Hong Kong and see all the audit working papers, and the non-SOEs can stay listed on the New York Stock Exchange, which would be a huge boon if accurate, and that's why you're seeing that as the best performer today.
But also, I mean, you have all this stimulus coming out of the Chinese central bank, which is quite the opposite of what we're doing here. Right? I mean, it's a completely different story, a completely different economy. They're locked down with COVID. We're wide open, but you get the point. Tom Hayes, Phil Flynn, great to talk to you guys today.
Thank you.
Thanks for having me.
All right, we have breaking news at